Welcome back to the Sell Ready podcast. So today we're joined by Ron Edmonds, a partner at Percipium White Oak and one of the most experienced M&A professionals in the lawn and landscape industry. Ron has spent over 20 years focused specifically on the M&A within landscaping, lawn care, tree care, irrigation, and related service industries, and has played a role in over 100 transactions. He's also the author of Green Exit, a book focused on exit planning for lawn and landscape business owners, and has spent years educating operators and entrepreneurs through industry events, publications, and advisory work. What makes Ron especially interesting is that he operates inside of one of the largest and most fragmented blue-collar industries in the country, where a lot of owners are building profitable businesses, but not necessarily building companies that are truly sell ready. So Ron, I'm very excited to have you here. Let's start
Thank
here.
you.
Just give us a quick introduction of your background and what you're focused on today.
We have started Percipium White Oak about 20 years ago. It's a third career for me. I spent 14 years in public accounting and another 10 or so in private industry finance. And we sold a company, and I was looking for something else to do and was being kind of deliberate about it, and started doing some consulting. And I just randomly got a consulting gig in the lawn care area, focused on acquisitions that a company was doing. I had done a great deal of acquisition related work in both my two prior careers, and so it was a good fit. But I thought this was about a 90-day project, and it's lasted about 2 or 3 years. And it got me in the middle of what was going on in lawn and landscape. And it was interesting to me. I saw how M&A advisors worked in the area. Thought we could probably do a good job. And so we hung out our shingle, and the rest is history there. It's been an interesting 20 years because we started out dealing with lawn care companies. And when I say lawn care, what I mean is fertilization and weed control companies. Think about True Green or those kinds of companies that come to your house 6 or 8 or 10 times a year and spray for fertilization and weeds. And that's a segment that's been kind of up and down over that 20-year period. We've done at least one transaction every year, but in that sector, but a few years it was very thin. It was not enough to sustain our business. We figured that out, that it was going to be like that pretty quickly, and so we expanded beyond lawn care into commercial landscape maintenance is our other really major segment, and it's been pretty steady over that period. Both of them have become quite popular nowadays. First, commercial landscape took off with private equity ownership, and really took off seriously about 10 or 12 years ago. I'd been going before that, and then lawn care came along about 5 years ago, and several private equity firms entered that market, and there's been quite a bit of consolidation activity during that period. We're pretty excited about that. That was kind of going back where we began in some area where we had an outstanding network, and so we've been having fun with all that going on now. And we also do other things in that sector. Irrigation companies are becoming interesting. Residential landscape companies are becoming interesting. So there's activity all across the board.
Yeah, and I'd love to learn a little bit more about that. Like, what's really making the industry so attractive right now from an acquisition standpoint?
Well, really, I guess several different factors. One is home service businesses in general have been very hot for the last 5 to 10 years. Some of those are pretty unexciting. Suggested that lawn care, lawn landscape are pretty blue collar businesses, and they are, but they're not any more blue collar than roofing and plumbing and HVAC companies, and all those have gotten pretty popular. As private equity has always been looking for new places to invest money that no one else has found yet. And at the same time, a big section of the private equity community is a kind of a follow the leader. If those people are interested in those areas, then there must be something out there. And so they're really crawling around pretty heavily now in those spaces. What else beyond just being home service, particularly in lawn care and also in commercial landscape, a significant part of the revenue that these companies generate is recurring revenue. So they don't have to be sold every year. That's a little different than you see in things like HVAC, although if you notice what's going on in those kind of industries, you see many of the private equity backed companies and others starting to offer membership plans where you pay for a membership, and they come out and do a inspection once a year and maybe give you a little discount for being a member, but they're really wanting to be back in your house so they can sell you more services.
Yeah.
So it's similar to the recurring revenue scenario.
Yeah, and how does how does the ARR really affect their multiple or their bottom line? And why you're specifically focusing on these like landscape companies, potentially because they have a reoccurring revenue, and how is that affecting their multiple?
Well, they're very desirable because if a business that doesn't have recurring revenue, a buyer has to resell all the time. So
Right.
it's sort of like zero based budgeting. You have to start from zero. Whereas if you have a $5 million worth of recurring contracts on the books and you maybe have a 90% retention rate, then you're going to start the next year with 4.5 million, and what you sell grows on top of that. And so the risk pattern is vastly lower with recurring revenue. And risk really is where multiples come from when it comes down to it. There's a lot of other visible factors, but primarily, it's what is the cash flow on this business going to look like, and what is the risk that after acquiring it, I'm going to be able to keep that revenue, that earnings stream. And it's a lot higher on recurring revenue businesses. You can
Yeah.
screw it up, but all things being equal, that really reduces the risk to the buyer, so that pushes the multiple up.
Makes sense. Makes a lot of sense. And I know that you've seen over 100 transactions in this space. I mean, yeah, yeah, golly, that's a lot. That's a lot. So, like, what really separates landscape businesses that receive a premium valuation from the ones that struggle to sell? Is it strictly because of that ARR you discussed, or what are they doing differently?
Well, really, there are a whole series of issues that distinguish a company that's going to be saleable and at a high multiple from an average company. And you can walk through them. We'll do that real quick. Probably one of the number one things is how reliant is the business on the owner. If the owner is heavily involved in delivery of services and has personal relationships with customers, that's going to be a little scary to a buyer if the owner isn't going to stay with the business. And so that's going to be a factor. So how strong is the organization? Along that line is, of the contracts that the company has, how much of that is concentrated in a few customers? So you can have great customers that might keep you busy all the time, but if it's one customer, then the risk again to the buyer of that customer not staying after an acquisition is pretty high. The mere fact of the acquisition may cause them to look elsewhere. So customer concentrations is a very important factor. How reliant is the business on one or more key employees other than
Right.
the owner? Address the owner, but if there are other people that are key to the business, no one else knows how to do what they do, and then the risk is going to be higher. Some other factors along those lines. I mean, are you relying on a supplier?
Mhm.
That's pretty unusual in the landscape business because the landscape supply is a pretty competitive world with multiple vendors in most places. But if there's something you need that you have to have, it only comes from one place, that's an issue. I would say the overall quality of the accounting records is a significant issue. You have to be able to understand the records. You have to know that they're accurate for that to be the basis for valuing the business going forward. What is the growth opportunity with the business? What's the growth rate look like, and what can we reasonably expect that rate to look like in the future? Are we constrained by equipment to where we'll have to buy a bunch of equipment, hire a lot of new people to grow it all? Is it in the wrong place? You may have a great business that's in a slow to no growth location that will be hard to maintain that level of growth. In these days, I think most people also look at how systems are used in the business, and part of that's closely related to accounting records. But most areas, segments of this industry and most others have industry specific, I guess I'll use the word customer relationship management systems. Do you use that? Or are you doing things manually, or are you just using the provisions that you can do in QuickBooks? People are looking for systems that work. That's not a deal killer usually, because a buyer might well roll you into a new software system. But if you're using manual records to take care of customers, then that's going to be an obstacle to a purchase, because the buyer's going to have to get that data into their computer. For example, in the lawn care business, it used to be common that the lawn care company would keep a record of when each, they call it application of lawn care chemicals, was done on a card. And that data is very important to the buyer. And so can they analyze it from the source it is, or does it have to get put into a spreadsheet or
Right.
somehow input into a new system? But quality systems can make a huge difference in how these businesses operate. A couple of examples of that are particularly the residential home service businesses, but it's true commercial too. Routing is an enormous issue where if it's route based, where the team goes to a series of locations every day, who goes where when can really drive profitability and keep you from paying people to drive around as opposed to doing services. So routing is important. And another angle on that is I'll loosely call it job costing. So do you really know how profitable a customer is? And, in fact, when you don't have job costing in place and a company makes an acquisition, one of the first things they're likely to do is to figure out how to evaluate customer profitability. And it usually are going to find out that there are unprofitable customers that you either need to reprice or resign from, and you'll make more money.
Yeah,
But
yeah,
if you
and
don't keep
I
records, you don't know.
yeah, that is true. You have to know your numbers. Yeah, I love to say like if you don't know your numbers, you can't grow your numbers. And
Yes,
the reality of that too, Ron. I love how you mentioned the pain point or that tranche of owner dependency, right? And when it comes to owner dependency, what I've seen in the blue collar space, and a lot of the SMB space for blue collar, I realized that there's a few type of operators. You have your solo operators who are very relationship based, like you described, and then you have your other operators who are subcontracting as well. And they may not be the one point of destruction, and because they're subcontracting all the work, but it's just not a most reliable business model. And there are very few who have the right structure in hiring and team management that you mentioned, and the right systems or infrastructure backing that as well. And I know that you said that would be ideal for their operational efficiency, alongside having the proper financial model.
correct. And, the owner dependency is an issue that, we often have to work on. And it's a kind of a mixed bag for owners because many owners grew their business by really focusing on the quality services they provide and are become sort of obsessed with knowing what's going on every piece of the business. Yeah, and at some point in time, for lots of reasons, it's best if people grow beyond that. We talk about owners that can take a 2-week vacation and not feel like they have to call to the office every day, as being one test of that, because that's hard for a lot of people. They haven't empowered other people to make good decisions. They're used to everybody coming to them for decisions, and that's one of the things people have to work on to maximize value.
Yeah, I agree. I agree, and I know that we're like really still early here, in our conversation. But I love to kind of dig a bit deeper regarding the landscape industry. I know it's become like extremely active in the private equity and the consolidation space. Can you tell me a little bit more about like how has buyer behavior changed over maybe the last 5 to 6 years?
Well, I mean, it has changed. Private equity discovered landscape. I mean, the first time really 20 years ago. And when that happened, there were some mistakes made. I call that the first wave of consolidation in the landscape. And there were a couple of companies that went out and bought up all the companies they could find of any scale. And actually, two of the major ones then quickly came together as one. And they made a lot of the mistakes you could find in a textbook. They didn't pay enough attention to how reliant the business was on the owners, for example. And here they bought 20, 30, 40 businesses, and many of the owners were pretty key, and they stayed however long they were required to by the contract, and then a lot of them left. And many of those people went out as soon as they could, either relocated to another part of the country or when their non-competes expired, and started another business. And some people, business owners, have done it. Have gone through that process twice, and a few 3 times. And but when the acquirers didn't really see what could happen there, they were too in a hurry to get deals done. One of the other things that happened was they didn't hold really true to their standards. And I'll give you an example of how that might have worked. So they're trying to buy a particular business, and they're negotiating back and forth with the owner. And the owner thinks about it and gets close and says, I'm really close to saying yes. There's one thing that's holding me back. And I've had the same office manager for the last 20 years, and I'm going to be working another 5 years. I just can't imagine working with anybody else. So I want you to commit to keep that office manager who handles the accounting and HR and whatever in the business. I want you to commit to keeping them for 5 years. And then a lot of people might have just quickly said yes to that that makes sense. We'll do that. And then it comes back one more. There's just one more thing I forgot to ask about. She's been my office manager. I don't mean to be sexist with that comment, but the office manager has been using the software that we've been using for the last 5 years. And he or she it's really unrealistic to think that they're going to really adapt to a new software system very quickly. So I'd like to stay on the old software system until she retires in about 5 years. And I can promise you that is the biggest mistake you could ever make in one of these things, because think about if you bought 40 $10 million businesses and made that commitment to half of them. One of the most important things for those buyers is to get control of the financial side of what's going on in these businesses they've acquired. And if you don't have them on a common platform, then people are going to send in Excel spreadsheets and you're going to have to do some sort of manual consolidation. And it's going to take you weeks to get to know what happened last month. It might take you a full month. And you really can't make constructive change when you don't know what's going on. And
Yeah,
so those kind of mistakes were made.
I hear that a lot, and I'm sorry to, even interrupt there, Ron, but, when it comes to, like, the data fragmentation, that's something that we're seeing all the time. And in the example you just gave, like, the roll-up operator having ten different, 10 different companies that they acquired, and then a majority of them not wanting to change off their software. Now they have so much fragmented data amongst their portfolio that it's so hard for them to be able to do the proper due diligence and also manage each and every company and also know where every dime is going in each company as well. And the goal, of course, with doing the roll up or as a roll up operator is to be able to have all your data streamlined so you can scale the businesses in unison and possibly exit, the roll up to a larger firm.
More interesting projects that I have done is about 6 or 7 years ago, I was hired by a private equity firm in Brussels, Belgium, that was
Hmm.
contemplating buying the largest landscape company in Europe and planning to go on an aggressive acquisition program and grow it significantly. And they wanted the history of what worked and what didn't work in landscape consolidation in the United States so they could avoid making the same mistakes. And so that was a really fun project. And I talked to a lot of these guys that went through the first wave of consolidation like that. In general, buyers have learned from those mistakes here so that very few are going to make that kind of mistake. That's not to say they don't make those or others, but that's a lot more rare than it once was. I think that with the experience of so many platforms today, there's lots of ways to know what has worked and what hasn't worked for others. Some companies rebrand to have everybody on the same brand, and some companies essentially never do that, which is I find to be kind of interesting. It's hard for me to imagine that there isn't ultimately a pretty strong economy from having a common platform name, but some people are doing that pretty successfully so far. Like in lawn care, TruGreen has always rebranded immediately on acquisition. Some of the newer ones, most of the newer ones don't, at least not quickly. They may do regional brands where they might buy a bigger company in a metro area like, say, Atlanta, and then buy some other companies, smaller ones up, and rebrand to whatever brand they're using in that area. But there's a lot of variability. One of the issues I find interesting in landscape is that of all the consolidators that are out there, the vast majority of them start out with saying that their thesis is to grow the business organically and by making strategic acquisitions. And what I found is that a significant number of those companies, maybe as many as half, never make any add-on acquisitions. And I've really pondered why that is. I think I have a pretty good idea now. And you're not going to get acquisitions done unless either the management team of that company or sometimes people from the private equity firm that work with it understand how to make add-on acquisitions. And they think that making add-on acquisitions is easier than finding larger platform acquisitions and executing them. And that's not necessarily the case, especially not if the valuations are low, because there's a big difference between being able to buy platforms at 7, 8 or higher multiples and thinking that you're going to be able to buy an add-on of any scale at 4 times, because it's probably not going to work for the sellers unless you're going to be limited to sellers that are in a hurry for some reason. They're ready to retire or have some kind of family reason to want to exit the business. Economics of it are not going to look very good. trading, let's say you have a company that has $1 million of EBITDA and somebody gives you an offer at 4 times, so that's $4 million of proceeds, and maybe you have $1 million worth of equipment debt you have to pay off, and you got to pay taxes on the transaction. And even if you've done good planning for taxes, it's going to be pretty high. Yeah. So say that's 30% maybe of the 4 million. It's 1,200,000, $1 million of debt. That's got you down to 1,800,000 of proceeds. You're trading $1 million of EBITDA for 1,800,000 in the bank, and even with interest rates being relatively low, relatively high, that's not going to be very attractive. And so it's hard to do that. And so there are some buyers are very successful with add-on acquisitions, and I've just noticed that it either is clearly coming from the background and experience of the private equity owner in executing roll-ups transactions, or there's some really talented people in the management team.
Yeah. No. I thank you for that. Thank you for that insight. I think that that was very important for each viewer. Like I hope you guys took notes because he gave a lot of information, a lot of great gems that I feel like you guys should take home, especially if you are in the blue collar space, if you have a landscape company. And I always like to kind of end the podcast off here with a segment. I want to like really like shift gears here, Ron. It's always a surprise. It's not going to be any crazy questions, but we always like to ask the same questions to each person we have on our podcast and every founder and operator that we have. And we call this segment the operator stack. And so we ask every founder and operator this because we're actually building a data set on how the top decision makers actually think when it comes to building and scaling companies, right? And so I'm just gonna have 5 questions for you, and then we wrap up from there. I ramble. I tell you the question, you give me your quick answer, and then we move on to the next question. Is that
Okay.
cool, Ron?
Sure.
Alrighty. All right. So the question number one is if you had to double the value of a company in 12 months, where would you focus first?
Double the value?
Yes, the
Is that what
value.
okay.
Mhm.
Well, one of the issues with doubling the value, I call this the magic of multiples,
Uh-huh.
because if you double the size of the business, you're probably gonna double the value as long as you keep the margins comparable. But you can also not just increase revenue, but work on those factors that I said affected the multiple, those
Mhm.
10 or so value factors. And the more you can change for the positive there, wrestle down the accounting issues that you might have, really work on having a number two who can take over from the business that shows that the business is not relying on you. Focusing on those issues will move the multiplier. And so that you might be able to grow the business 30% and still double the value by moving the multiplier up.
I love that. I love that. And then the 10 major or the major value adders or that can add value to your multiple. I know financials is what things that we discussed as well. Owner dependency, right? And what about financial modeling? I know you didn't really tackle too much on financial modeling aspect, but you mentioned a little bit about the recurring revenue. Is that adding a large impact to the multiple in the blue collar space?
It is, I mean, and some parts of the landscape business, for example, don't have much in the way of recurring revenue, but there are things you can do to add that. For example, among tree care companies, their business is not usually recurring. The better ones keep the same customers coming back, but they're not under contract. But nowadays, a lot of tree care companies have added what they call plant health care, which is kind of like lawn care for trees and shrubs, where they evaluate health of those and use chemical treatments and fertilizer to enhance the life of those trees and shrubs. And that's a recurring model where they come out 4 to 6 times a year typically. And we see the same thing in things like irrigation companies might have a membership plan. It's kind of like we were talking about HVAC companies have started. There are things you can do that way.
Understood. Got it. We'll move on to question 2 here. Well, what's the most common bottleneck that you consistently see that prevents companies from scaling?
Probably reliance on the owner, because the owners have a limited capacity. And if they are only going to do things that they can control, they're not going to probably even want to try new things that much. I mean, they got there by doing what they like doing and what they've learned how to do, and they might not like change. But that's one area of change that it's pretty important. One of the things that's very powerful in our space and lots of others is peer groups, where groups of owners get together. A lot of times it's monthly by Zoom and quarterly live or semi-annually live, and they have a group of people with similar types of businesses and size of businesses in other non-competitive locations meet, share their numbers, and it's kind of an accountability group too. So you said you were going to do this, but you didn't do it. And that's one way that people can realize what they need to do, and is to see what's worked for other people and develop those kind of relationships.
Love it. I love it. Owner dependency, number one gap. All right, question three here. We only have two more after this. So, when you're evaluating people or even a leadership team, what's one signal that immediately tells you someone is A plus talent?
I think it's pretty quick. You can usually tell pretty quickly, and it's usually based upon the questions they ask. They recognize what they don't know because they want to fill in the gaps. And the best people ask lots of questions.
Sounds like I'm A plus talent here on the podcast, asking a billion questions here. All right. Question number four here, Ron. When you're making high stakes decisions, what's the first principle or framework that you rely on?
Scotch whiskey. I don't know that I have a good answer for that question. I try to think through all the implications. We go through a process when we take on a new client, and sometimes we're concerned about some aspect of them. Yeah, maybe it's they don't seem totally forthcoming, but we try to operate sort of collegially with my partners. And if I have a concern, I'll run it by my partners and we'll kind of make a group decision. But usually comes down to instinct, and we're usually right, but not always.
Yeah, following your gut and then just a bit of group think, being able to discuss with your peers, colleagues. I mean, I love that. All right, last question for you. Save the easiest one for last. What's a mistake that you see founders repeat over and over again, and it just costs them the most money?
Well, in terms of value, I think that a lot of owners are not very aware of their business as it compares to other businesses. And, they hear about the price that somebody else in their industry was able to get for their business. And they think, well, my business is just as good as that one. And so he got a giant multiple. He got 7.5 times EBITDA for his business. So that's ought to be what my business will draw. But if you don't really do an evaluation of what your business is and what's different about your business from another one, you may be coming to a terribly wrong conclusion, because there may be very specific reasons why those other businesses sold for a high multiple. And you may have made a decision not to do those things, even though it seems like it works for you because it's developed a good lifestyle for you as the owner. It's very hard for people to take an independent look at their business and understand its strengths and weaknesses. And that's one of the reasons why we think that the peer group model is fantastic, because people can't hide there and they have to be open-minded and listen to the other people in the group. And if they don't play by the rules, they'll throw them out of the group typically. But a lot of people have had their eyes opened by seeing how other people's businesses work. And in landscape in particular, a significant number of people who own good-sized landscape companies that have 10, 15, $20 million of revenue started their business by mowing lawns when they were in high school. And they may never have really worked for anybody else. And they have focused on what has worked for them to so far, but what's worked for them may not work for other people. And there may be better ways to do things that you need to be open-minded to. And I think a lot of people don't really understand how their business compares to others.
Yeah, Ron, that was extremely valuable. I really like hearing your perspective from inside such a large and evolving industry. So thank you so much. I think a lot of operators underestimate how value can actually be created in the blue collar and service space when the company is really structured the right way. So you brought a lot of
Great.
clarity to that today. For anyone listening, we're gonna link everything below so you can go check out Ron. You can go check out Percipium White Oak and what they're working on. I appreciate you so much for coming on, Ron. Thank you so much.
Well, thank you. I appreciate the invitation, and I've enjoyed it very much.